Hello, Oracles. Well, we've got some good news and we've got some bad news. The good news about Tesla is we filled the gap down to 728. The bad news is we had to fall 6% to get there. And I was fully anticipating that we were going to fill higher gaps before we came down to fill this gap. I was wrong. It happens. Either way, we have now filled this gap. Where we go from here, I truly don't know. I'll dive into Tesla a little bit more in the morning. But for right now, I kind of want to go into some of the reasons why the market was reacting the way it did today with the NASDAQ pulling back. We've got oil prices still going up. This is not good. This is not a good sign. We have a lot more indicators now that we are definitely going to be getting into a recession. I personally think there's much higher chances that we get into a recession, and I think that we are going to get into more than just what I thought was going to be a paper recession. I think we are going to get hit a little bit harder than we had anticipated before. Elon actually mentioned it today, how he thinks the next 12 to 18 months could be rough. And several months back, somebody had asked Elon what he thought about a recession coming up, and he said probably spring or summer of 2022, but no later than early 2023. Sure enough, here we are, potentially facing a recession right when Elon said. And now we can argue that maybe Elon's from the future. Elon's a smart guy, and what it comes down to for Elon is he's very data driven and he's very engaged in his business. And obviously his business with Tesla has a lot to do with it all encompassing, the global economics and supply chains and all of it. So he has his finger on that pulse very closely. So for him to come up with this, it's all data driven, and he can see, well, we printed a ton of money and we are now getting to the point where supply chains are pushing everybody. We're getting to the point where people are going to stop spending money because prices are too high. So he just sees it. He sees all these pieces of information and his brain puts it together and thought of these numbers. So it's really just a data thing to him, but it ended up looking like it could probably come true. We obviously won't know for sure if we're in a recession until the end of July, beginning of August, when we get GDP numbers. But a lot of indicators are pointing towards a recession happening. And with prices continually going up, we see the housing market potentially seeing a strong pullback coming by the end of this year. When we see the housing market start to pull back, we see construction pull back. When we see construction pull back, a lot of other spending tends to pull back as well. When you get into a recession, we're going to see people are unfortunately going to be losing jobs. So the silver lining for all of this, because I'm a silver lining kind of guy, I like bring balance to the force. Even when we're super euphoric, I will bring us back in line as well. So right now, the silver lining for a bad recession coming is we currently have one person for every 1.9 jobs available. So if we get to a point where we hit a recession and people start losing their jobs, it's not so much that we don't have the jobs available, it's just that those people unfortunately will have to learn a new skill for the jobs that are available. So we can kind of wash that in both directions. Another part of the silver lining is we still have currently very high inflation. You go back to the 80s when we got Volckered and we had a forced recession to bring inflation down. This is not the scenario that we are in, but if we get a recession, it will pull inflation down. So yes, it stinks that it's going to have to go that route, but it seems like that's going to happen. So again, I still want to have faith that the Fed is going to be able to raise rates and give us a soft landing, but we do have a lot of indicators that are telling us that we are facing a recession coming. And we've talked about it before, about the next 12 to 18 months being rough in the stock market. It's going to happen. You go back to 2008 and 2009 with that recession, and it sucked. And we've talked about it before on here. Try to hold a plank for a minute. That is a very long and gruesome and brutal minute. Same thing's going to happen. So for the next 12 to 18 months, and we've already been going through it for almost 6 months at this point. So we're going to be looking at, almost 2 years of roller coaster, sideways, bear market trading. But again, fortunes are born during a bear market. These are the times to hunker down. And I was speaking to one of you in the comments today, and they're like, you know what? I'm just going to sit on the sidelines until 2025. Wake me up when that happens. And realistically, if you are somebody who you don't enjoy the roller coaster ride at all, pick your high conviction stocks, set yourself up with a recurring dollar cost averaging investment for the next 2 to 3 years, and then just walk away and just let it take care of itself. That's simple. Now again, I'm not a financial advisor, but realistically, if this is how you are emotionally with the stock market, just set it and forget it, because one of the best things you can do for your portfolio is nothing. Sometimes the best thing you could do is nothing. And if you're going to be investing during times that are rough, dollar cost averaging has been proven to be the most effective way to grow your portfolio in the long run. So if you dollar cost average and set it and forget it, you will most likely see very good success over the next 3 years. Obviously, there's a lot of things that can change. We've got a lot of ups and downs, a lot of unknowns and uncertainties right now, but I'm going to continue to follow this. If you don't feel comfortable following it, just set it and forget it, walk away. Otherwise, I'm tracking these roller coaster rides. Looking at Tesla in particular, Meet Kevin was discussing how, 25% of the time we have traded for Tesla below analyst expectations. And right now we are trading 28% below analyst expectations and their price targets. You go back to 2019 and we were trading 50% below. If we drop down that to that 50% below, we'd be looking around the 450 to 470 mark. Now we go back to the gaps that we were talking about, and that one random gap back from November of 2020 down to 489. If, and this is an if this happens and we pull back to 50% below analyst expectations, we would fill that gap at 489. So can this happen? Yes. Will it happen? We don't know. But the way it's been trading, anything is possible. And it's been nuts, especially with Q2 coming up with, we know that we are expecting a not so great Q2. Shanghai is looking like it's not going to be opening up until June 1st on that second shift, trying to get us back to that 2,600 vehicles per day. So our Q2 numbers might not look all that great. We know this, we expect this. The way I view this is, it is a one-time occurrence that is not going to be long-term affecting, so it'd be a great buying opportunity. So if, God forbid, we happen to have massive macro weight that pushes us down even more than we already are, and we have a bad Q2 that is going to pull us down even further, it's just an amazing buying opportunity. So again, we'll dive more into Tesla in the morning specifically, but looking at the overall market, looking at how we're still continuing to push down, again, I thought we were going to rally. Maybe we will. Maybe this was more of a bear trap that happened today. Maybe. I don't know. Let's see how the week plays out for the rest of this week. But just following some of the trends, we have been on a downward trend. We know that historically, we do not pull out of these things until the Fed stops raising interest rates. That is going to be for another 12 to 18 months. So we've got 12 to 18 months of this joyous fun to go through. So again, cash flow generation is key. If you can get cash flow generation to invest as much as you can during this time, when we pull out of this, you are going to reap the benefits of it. And it's just a matter of what stocks do you want to be in over this time frame when we come out. We've got, Warren Buffett is investing himself into oil right now. An argument can be had to say, if this is going to be oil's swan song, they're going to have their one last run. Sure, maybe for a short-term trade, go ahead and jump into some oil stocks. Personally, I don't want to support that because I like to go on the green energy side of things, so I'm staying away from it. But for anybody who just wants to make some money, maybe it's a good thing to get into. Personally, I'm staying away. I don't like it. I'm not going to get into it. But anyway, this is where we're headed based on information that we have gotten recently. And again, I'm taking everything day to day. Every day we get new information, and you've got to be agile on your feet. We've talked about it all year long, being an agile investor. And being agile doesn't mean you've got to just stick with one thing. You've got to be able to move. You've got to be able to be like, all right, well, I've got cash ready to be able to do whatever I need to do with it to invest, and just being able to change your strategies up as the market changes. Again, if you're going to be a long-term investor, really doesn't matter. Pick your long-term stocks, put your money into it, set it and forget it, and you're good to go. Otherwise, just make sure you're staying on top of information and doing your own due diligence and research to see where you think the market is going to be going based upon what your plans are for your portfolio. Thank you all so much for watching. I appreciate all of your support and feedback. If you have not subscribed, please do so down below. Sign yourself up for notifications. I am over on Twitter at OracleTim1. I share all the latest Tesla news, pertinent stock market information, and all of my daily trades. Thank you so much. Have a great one.